Earlier today, I spoke with Jacob Kirkegaard, senior fellow at the Peterson Institute here in Washington, and I asked him if the EU's plan for a banking union will bring the economic security that the Eurozone so badly needs and wants.
Basically, what they're arguing about is who decides when a bank is failed and who pays for it when you have to shut it down.
So I would imagine that if the issue is how do we save the failing banks in the event of failure, basically to avoid another crisis in the future, that most people want to be saved and don't want to pay. How are the countries in Europe going to resolve this matter? Because they've had a very difficult time in agreeing on many other related matters.
Yeah, I mean, this is basically about the money. And everyone wants to pay as little as possible. But the one thing that all the governments can agree on is that the first group to pay, unlike previously in the crisis where it was really taxpayers that paid, everyone agrees that this time it's got to be the creditors and the bank shareholders that pay first. That's what they call the so-called bail-in principle rather than bail-out. Secondly, there's going to be a certain amount of losses that's going to be borne by the national governments, so that if an Italian bank fails, for instance, it will be first and foremost the Italian government and Italian taxpayers that stand behind it. And then at the sort of final line of defense, you will have some sort of common pool of European money that can be injected either directly into the bank or from a sort of a cheap loan from Europe to the Italian government. So it's sort of a multi-stage approach.
One of the problems with the financial crisis that a lot of people did not realize was the unintended consequences because of the counterparty risk. Bank A borrowing from Bank B, which borrowed from Bank C, and so on. One bank collapsed, and there they all go. How is the union going to prevent that level of failure?
And that's why basically governments back in the crisis were forced to pretty much bail out all the banks, because we saw what happened when you let one of them go, like Lehman Brothers. So it's really about that each individual bank in the euro area needs to have a credible set of transparent numbers that the market trusts. And the problem is, right now, there are many banks in a number of countries, Spain, Italy, and others, where the markets basically have no confidence. So it's really up to the ECB to establish this credibility by being rigorous and transparent about what they're doing.
If you look at the rules and regulations, if they're not enforced, if it doesn't have any teeth to them, if people don't follow the rules, the problem isn't the banks are the ones following the rules, the problems are the banks that don't follow the rules. How are you going to ensure that there's going to be fairness across the board and it will actually be enforced?
Well, this is really sort of one of the core issues of the banking union, because what the banking union is really about on the regulatory side is to basically take away the responsibility for regulating banks from the governments in individual countries and give it to the sort of multilateral or supranational regulator at the ECB, precisely because you want to avoid this, what we saw earlier on in the crisis, that basically Spanish regulators were sort of, looking the other way when there were problems in a Spanish bank, and similarly in Ireland, for instance. So you really want to have a neutral, sort of outside pair of eyes, precisely because you want to avoid this kind of collusive behavior.
But to have outside pair of eyes, you need transparency. Do we have that?
Well, this is the big, shall we say, technical challenge for the European Central Bank right now. So what the ECB really has to come up with, together with something called the European Banking Agency or Authority, they need to come up with common rules and regulations for the entire Eurozone. And that is quite an extensive technical undertaking, and it will, for many banks, that now will all of a sudden go from being regulated, the Spanish way, to being regulated the European way. This can have very significant implications for things like non-performing loans and other key financial ratios.
There isn't much time to get this deal done on the self-imposed deadline by the end of 2013. Can a deal get done? And if they don't get it done, what does a failure of coming to a deal right now mean, or could they possibly just end up delaying it?
Well, I think a deal will be done. But I think a deal that ends, that finishes, that ties up all the loose ends is not realistic at this moment. But you will have what I would regard as a political deal between the governments about the big picture, about basically who pays and how do we decide about when a bank is doomed and needs to be shut down. And then you will have to leave it to the technical experts to cross the T's and dot the I's over the coming months so that the final legislative language can be passed by parliaments in the spring of 2014.